Now, please welcome Paul Kraft to begin.
Thank you, and welcome everyone to our fall mutual fund directors exchange. We're happy to have everyone here. We've got a great lineup of directors listening in today, so we look forward to your questions and interacting with you as much as possible as we can in our virtual format. So, just by way of introduction, Paul Kraft. I'm the investment management marketplace excellence leader, a partner in our Boston office in the investment management practice, and serve a variety of clients as well as participate in our investment management marketplace team. The next slide is probably the most important slide. This is the great cast of teammates that I have with me today to talk about issues that are important to you, mutual fund directors. So we're going to try to lean into the lens of the mutual fund director and make sure that we give you some content today that you can take back to the boardrooms and discuss with your fellow board members as we go forward. Next slide. As we thought about the agenda, we thought it was important to definitely gravitate towards a lot of the issues that are in the marketplace today and things that would be on your board agendas. So hopefully we've covered off on those. And again, feel free to ask any questions that you might have. If it doesn't pertain to one of these topics as well, we'll certainly be able to entertain that given the caliber of my teammates that are attending today. Next slide is our first polling question. So just to kind of get things revved up, as there's a tremendous amount of change and transition going on in the industry. The fund groups you serve, as they look to the future, what products or levers have they invested in or plan to as part of their strategic growth plans? So obviously separate accounts, separately managed accounts, business development companies, digital offerings, collective investment trusts, ETFs. We're going to obviously dive deep into that. Inorganic growth through M&A, private credit, debt products, or other alternative products. So if you want to take a second to respond to that poll, that would be great. I'll take this opportunity also to bring in Amanda Nelson, who's going to lead us through the first topic. Amanda, what are your contacts and conversations suggest that the number one result will be here?
So I'll be interested to see the results. My guess is it's going to be a little bit of all of the above. I think from an overall kind of focus of time spent right now, ETFs are certainly among the top. I think SMAs from a customization standpoint and trying to give greater personalization and customization to individual investors is right behind that. And then I'd say anything alternatives related. So trying to bring alternatives to the masses, particularly to high net worth space right now, is the third key trend that I'm seeing. And it looks like, and now that I'm starting to see the results, that's about right. So ETFs in the win,
You're spot on. I can't wait for
SMAs,
your
and then and then private credit, debt, and other alts products.
Can't wait for your introduction and your presentation. So I'll let you continue.
All right, very good. Well, good afternoon, everyone. It's good to see you all virtually or know that you're there somewhere. Just by way of background, my name is Amanda Nelson. I'm a partner in our Casey Quirk practice focused on advising investment managers on a range of strategic initiatives. And I work with firms of all shapes and sizes, some of the largest kind of more traditional diversified managers, and also some small specialist private markets managers as well. So I'm going to spend just a few minutes up front talking through some of the big shifts that we see happening in the industry. If you go to the next page, please, we'll just position sort of the content that I'm going to walk through today. Overall, I'd say, the industry is healthy and operating margins remain strong, but the search for growth and the search for scale has become more elusive as the industry has matured. There has been, and frankly, there currently is just a lot of disruption happening now in the industry that's redefining where firms play, how they win, and how they organize themselves to capture some of the net new flows into the space. But that disruption is also creating a lot of opportunities for innovation. And I'm sure all of you at your firms are experiencing this. We read it in the news on a constant basis, but many firms are taking different approaches to innovate, to change, and I think as we look to the future, those that are willing to adapt will be best positioned to succeed going forward. If you flip to the next page, please. Thanks. So from a financial standpoint, the industry remains highly profitable. Operating margins are still north of 30% for most firms. You do see a bit of a different experience depending on the firm type, where they focus from an asset class perspective, and also from a scale perspective. So generally speaking, when we look at both kind of the growth opportunities in the industry right now, who's gaining more flow, as well as the profitability of those firms, there are some nuances depending on the firm mix. So firms with alternatives and private markets capabilities, to no surprise, I'm sure, have been outperforming from a growth standpoint, as have some of the largest kind of mega asset managers when compared to more smaller specialized firms. Generally speaking, we're seeing assets and flows kind of consolidating amongst the largest firms as clients are seeking to work with fewer and fewer providers, and as brand and scale become increasingly important. Next page. So if we take a step back, I think it is an interesting time that we're in right now. The industry is entering a new phase of maturation. So prior to the global financial crisis, the industry was really characterized by, super high organic growth rates. There was very limited fee pressure. The mutual fund was taking off in terms of the vehicle of choice, and it was a pretty fragmented market where a wide range of firms were highly successful. Following that kind of first phase of the industry, post the global financial crisis, you started to see consolidation happening. So growth rates started to slow, fees became increasingly under pressure, passive became a really big growth driver in terms of the overall assets in the industry, and alternatives started to come online with winners consolidating share. Then we hit the pandemic, which was another kind of reset for a lot of the industry. And today we're in an age where kind of long-only assets are a takeaway game. Private markets are replacing public markets in a pretty big way. Customization and personalization is key, and the role of AI and technology are at the forefront of industry disruption. Next page, please. In this kind of more mature environment that I described, scale has also become hard to come by. So we conduct a study every year called Performance Intelligence that essentially benchmarks the industry and individual firms within the industry to one another and gets a sense for, what does the P&L look like? How has that changed over time? And I think a couple of interesting things jumped out at us this year in particular, which is one, costs are increasingly going up, which is driven by all of the things that I talked about before. So new product capabilities coming online, new market channels, new segments, and new technologies that are just required to compete. But it's driving up the overall cost base of most organizations, and it's driving up, frankly, the fixed cost base beyond just the variable costs that are closely tied to people in this space. And at the same time, we're having kind of declining productivity overall. So more costly, people are less productive, and it's creating this complex landscape and environment that feels kind of difficult to win in for many firms unless you're one of the biggest players in the space. So really all facets of the industry here are facing disruption. Capital markets, we all know, have moved from historically really being financed by public markets to leveraging private markets to finance much more heavily. From a product demand perspective, we, historically saw kind of the active passive barbell in the space, and that's being redefined, particularly on the active side, where public and private is actually converging and coming together. You see a lot of firms launching new types of products within that space, and you see allocators and individuals actually reassessing, what should my allocations within my active portfolio look like? Is it really equity and fixed income, or are we replacing those more with alternatives and private markets capabilities? From a kind of distribution and client need perspective, what used to be more of a one-size-fits-all model is being redefined by much greater personalization and much greater customization, particularly when it comes to, in the individual channels, just the demand for kind of specific personalized product needs. And I think that's one of the drivers behind the growth of SMAs that many of you articulated as something that's key to your own businesses. And then separately on the institutional side, also the growth of customization and personalization as it relates to things like I need a customized report when I need it at a certain time. And my expectation is that my asset manager will be able to deliver on that. And then there's a considerable kind of reassembly of the value chain and a blurring of the lines in terms of the industries that participate within the investment management space. So you have the kind of debanking that led to the growth of private credit within IM. You're seeing much more convergence between insurance and private markets as firms are creating more tie-ups and partnerships. There's a blurring of the lines between investment managers and tech firms. So you're seeing a lot of investment managers actually buy tech platforms or buy data providers, and trying to get into the technology space much more than the product manufacturing space that historically was king. And then there are kind of blurring of the lines between investment managers and wealth managers too. So you have firms that have a broad range of capabilities expanding from one end of that value chain to the other and looking at new ways to compete and drive new revenues. And then the final piece that seems to be kind of very prevalent and top of mind is just the shift in the operating model. And this industry has always been a headcount driven industry. It's a human capital business, but it's being much more enabled by technology, AI, and third-party vendors today. So I wanted to tee up one more quick polling question here before I continue. Just based on some of the themes that we talked about here, I'd be curious to hear from all of you where you think, which industry theme you think will most dramatically shape the future of the industry over the next few years, whether it's the role of private markets, the need for customization and personalization, industry convergence, or AI.
And I think I always find it interesting that M&A never leaves the agenda. It seems like it's always at least predicted to be more than it ever seems to materialize.
Yeah, the M&A discussion, it's true. It's an interesting one. I think right now, though, there is some activity. At least there's lots of discussions on M&A as it relates to either private markets, which is clearly a category that's in focus here, or increasingly, I think firms buying tech providers or data providers. And so the old days of just kind of combining two big asset management firms for the sake of scale seems to be less common today. But from an M&A standpoint, if it's filling a specific product gap in private markets, or if it's filling a specific capability gap when it comes to technology, I think you are seeing some interest. But AI looks like seems to be the winner here in terms of what's going to dramatically reshape the industry. No surprise there. This page just wanted to highlight a bit around, some of the innovation that we see in the industry that's coming out of a lot of the disruption that's happening. So you have product innovation with private markets players seeking kind of new sources of origination and balance sheet access. That's leading to a lot of the insurance and private market firm tie-ups. You're seeing kind of public and private partnerships between some of the more traditional diversified players in the space and some of the mega alternative shops at creating kind of new products that can be brought to new markets, specifically as it relates to the individual-led markets. And then there's some innovation around kind of fintech and data purchases. And all of this, I think, is just kind of reshaping and redefining how asset managers think about the capabilities that they're bringing to market and what really differentiates them vis-a-vis their competitors. On the next page, we get into a little bit of the overall kind of asset class demand view. And I'd say just taking a step back, when we look at where demand will come from over the next few years, there's kind of both what's the money that's in motion, which is the global revenue opportunity view. So how much money is moving in and out of plans? Where do we see opportunity for kind of a takeaway game from one manager to the next? And that's why you still see kind of active equity as a really big category here, despite the fact that it is an outflow across most of the globe. The flip side would be in areas where you actually see a really high organic growth rate or kind of net new flows going into categories in places like private credit, regional core plus. Those are the areas where, demand is really driving kind of forward future growth, but it's coming off of a much smaller base in terms of the assets that are currently invested today. But I think overall, and I know Doug will talk about this in a little bit, the growth of private markets is certainly one of the kind of most in-demand topics right now from all of our clients, both as it relates to institutional clients who have, frankly been allocated to private markets for a very long time, but of course now increasingly in the individual kind of retail market and in the defined contribution space with some of the new guidance that has come out around being able to unlock that opportunity there. So I think from a growth standpoint, if you were to kind of separate the private markets growth within institutional and retail, the growth rate within retail is somewhere around 20% is what we're anticipating, versus on the institutional side, closer to kind of single digit growth. If you flip to the next page. So in addition to some of the data points that I talked through earlier that we capture from our survey, we also look at just what's the cost structure of the industry and how has that shifted over time. And I think, interestingly, year over year, the changes don't feel very significant if you just look at kind of 1 year to the next. But if you look at a 10-year time series and take a look at what did the typical industry firm look like 10 years ago versus what does it look like today, there are some pretty stark differences in terms of the headcount and the overall spend and the composition of that spend. Most notably, I would say, is the kind of gray tech and data bar. So tech and data headcount has increased over 150% over that 10-year time frame. Previously, it represented about 12% of costs at most investment managers. Today, it's about 20% of costs. So a really significant jump in terms of the overall spend and budget going to technology and data. And I think a lot of that's being driven by, the need to modernize the data and technology infrastructure. There's a lot of consolidation and rationalization of various platforms to support new asset classes. You've seen kind of the advancement of a lot of the third-party vendor solutions out there being able to serve very specific needs across the value chain. And then there's just been a drive and a push for greater productivity throughout the entire organization, and the goal of investing in technology and data to hopefully try to unlock some of that productivity. And of course, then a focus on automation and leveraging AI where possible. So the tech and data piece, I think, jumped out to us the most as kind of one of the big changes over the last 10 years from a cost perspective. The other two that jump out to me are, one is the kind of shift in middle and back office operations. So headcount has actually remained relatively flat there from that 10-year time frame. But if you look at the spend, it has increased over time. And so that would suggest actually the industry is outsourcing more today than they were historically and using third parties to fill some of that spend. And then the last piece would be just the investment management function and capabilities. So this is the portfolio managers, the analysts, the research team. The headcount in that space has actually gone down quite a bit over that 10-year time frame. And I think that's being driven by kind of the role of data and the use of data within the investment process, which has led to kind of less of a need and less of a focus on having huge research teams and huge analyst class to analyze data, and instead using the data that is available as a way to turbocharge some of the idea generation and the portfolio construction that's taking place at most investment management firms. So a pretty interesting shift from the overall cost composition over the last few years in the industry. But overall, I think this has been a space that has been the industry has been changing really rapidly. We've seen a lot of disruption and a lot of change. And ultimately, we think the firms that are going to win are those that are ready to respond to that change in many ways that align them to their own kind of value proposition. So final page here is just kind of how we think about competitive advantage and scale. I think first and foremost, growth is a battleground, and so figuring out what are the components of the industry right now that any individual firm is well positioned to take advantage of, and how are they going to grow their business. Two is like, how are we going to leverage data to make us the most effective investment management organization, whether it's to support our investment management capabilities, to support our sales and marketing team as they're going to market and meeting with clients, or other ways. New distribution models, so customizing, personalizing as much as possible to create that edge, and then reallocating investment to actually innovate and create operating models that can support where the business is going versus where it has been in the past. So I will pause there. I think some of these topics we'll dig into and double click into in the coming sessions, but I do want to make sure we allow for some questions if there are any.
Amanda, I'm not sure if you saw it. There's a question in the Q&A.
I did not. Hi, John. Good to see you, or good to see you out there. The question was, are you seeing M&A of traditional institutional asset managers and emerging RIAs? I would say this has been a topic that has come up from some of our investment management clients, but we've seen this more in terms of kind of the wealth management space. You've seen more consolidation of RIAs, and you've seen more wealth managers kind of pursuing the RIA channel more aggressively. I have not seen in a meaningful way investment managers kind of buying RIAs much more than they were historically, but I do think it's a conversation that's happening right now, specifically as investment managers are thinking about what's the right distribution apparatus for us to get our product out to market. And so it is certainly a topic, and we are seeing consolidation within the RIA space as well. Do we want to flip to I think there was one more poll, Paul, that you were going to tee up.
I think, Paul, you're on mute.
Sorry. Thank you, Amanda. As we think about Gen AI and again, in the fund group, you oversee with regards to where you are kind of on the maturity curve there. We are learning and mobilizing pre-work. We have not invested a significant amount of time in Gen AI. We are scaling several use cases in production environments. We have several pilots underway, and then probably the more advanced, we have a few 3 to 5 use cases in production already. So, man, any thought how you'll see Gen AI get put to use? I know you covered a little bit of it in some of your questions, but anything we're seeing as far as is it going to be all internally developed, or are we starting to see solutions out there in the marketplace that might accelerate the pace?
Yeah, I think look, this is certainly one of the most topical discussions happening right now. I think most firms are in a place where they have already deployed Gen AI in some shape or form, and often across most of the business in various use cases. Right now, I think the questions that we're getting are really focused on ROI and can we actually achieve that ROI that we have all heard about? And I know there was a study from MIT that came out recently that basically said the answer is for most firms, this is an industry agnostic view, but for most, the answer has been that the ROI is hard to measure or has not satisfied what was anticipated originally. I think the reality is we're kind of early days here. So I was in a discussion right before this actually with a client, and we were talking about some of the uses of AI within the industry. And I think right now you're actually seeing about 80% of firms have deployed Gen AI in a pretty meaningful way and are planning on continuing to do that. So it's a concept that's here to stay. But I think the kind of ROI discussion is one that will continue to evolve. And one of the complaints I have heard is, even if it's making people more productive and they're able to spend time on higher value things, that's not necessarily accruing back to the firm today. It's accruing back to the individual. So you may see someone, oh, I now have time to actually go out and get a coffee or go spend time on things that I am more interested in instead of, that productivity gain getting back to the firm. So I think more to come, and we'll see how this evolves over time.
Great. Well, thank you. Next slide, and I know Ryan and Bruce are going to cover that from another point of view as well. So, Ryan?
Sure. Next polling question here. In your role as a mutual fund director, which of the SEC's latest rules, proposals, or topics of discussion provides the greatest challenge, opportunity to the fund group to adopt or implement? So we've got a bunch of rules on here, many of which were on that SEC 2025 spring agenda. It's fall in the rest of the country, but I guess it's spring in DC as they're a little behind putting out their agenda. Here I think it really probably depends on if your fund group has an ETF share class application with the SEC, and there are many. I know there's about 77 applications. We'll talk about that. Unless you've also got ETPs and interest in crypto, a lot going on in that space. And then we'll talk about the 17A7 cross trades, which could be applicable to everyone. It's been kind of a thorn in the side of asset managers since 2A5 came out. So looks like ETF share class approval here is the most popular. And if we go next slide, we'll just do some quick intros. So as Paul mentioned, I'm Ryan Moore, audit partner, previously spent 3 years at the SEC and currently lead our IM regulatory group within audit. So help to clients understand and implement some of these SEC rules. And Bruce?
Yeah, sure. Thanks, Ryan. Good afternoon, everybody. Bruce Treff. I'm a managing director in our consulting practice. I focus on investment management and wealth management with a lens towards regulatory and compliance issues, working with firms across banking, asset management, traditional alternatives, as well as insurance organizations that play in the space. So thank you.
Great. And we're going to stay here for a while. We don't have a ton of slides. And there's certainly been a lot going on in Washington at the SEC since Paul Atkins has taken over as chair. And given some of those changes in deregulatory swing, there's not a lot of new rules to discuss yet. So we're going to focus more on some trends that we're seeing from a regulatory and enforcement lens, hitting on some similar topics throughout this whole presentation, which will be covered in more detail later, like ETFs and private credit. But that said, we will cover the new agenda and how those priorities and themes are really reflected in this new agenda. But first, I'll just mention and highlight a couple of the key people driving that agenda. So I mentioned Paul Atkins. He was a former SEC commissioner from 2002 to 2008. This is actually his third tour of duty at the commission. He's really known for his advocacy of free market principles and opposition to excessive regulation. So he was really appointed as chair to bring a balanced approach to regulation. In the division of IM, there's a new director, Brian Daly. He previously served in senior roles at major financial institutions, recently coming from a law firm, Aiken Gump, Strauss and Hauer. And then in the division of enforcement, there's a new judge, Margaret Ryan, new head of enforcement there. Bit of an unconventional pick, but could be a signal that the SEC wants to keep within its jurisdiction, as they've had some court cases go against them where they were found to really exceed their authority or jurisdiction, as we think about the private funds rule, for example, which was vacated last year. There's a new chief accountant in the commission's OCA, Kurt Hull, former EY partner, but we're still awaiting a new chief accountant in the division of IM. And there's some other slots as well. Many examination enforcement attorneys have left the SEC in this latest administration change, kind of by design by the government. As everybody's seen, the SEC has been trying to cut back on managers and staff, most recently having a $50,000 buyout for supervisors. So the SEC will continue to look to do more with less. But as we think about the new priorities or focus areas, we really think there's three themes coming out of the Atkins SEC. First, a focus on crypto, digital assets. Second, providing a greater retail access to private funds. And third, focusing on innovation or capital formation, such as with the ETF share class for mutual funds. So just touching on crypto first, one of the first orders of business that they came in and they established a crypto task force really to address fraud and misconduct in the crypto space and coordinating efforts across the SEC and other regulatory bodies on this task force. So this task force led by Commissioner Hester Peirce, who's been a strong advocate for clear and fair crypto regulations during her term. And the SEC plans to host a series of roundtables on key areas of crypto assets as we move towards the spring. And actually on that agenda that I mentioned, there are two main crypto-related rules. First one around crypto assets, relating to the offer and sale of crypto assets. And two, one on crypto market structure amendments to account for the trading of crypto assets on alternative trading systems and national securities exchanges. There's actually a third one related to amendments to the custody rule, which will encompass digital assets as well, and an update from the prior safeguarding rule, which was on the agenda under Gensler. In fact, the SEC has reached out to us and a few other firms, I'm sure, in regards to those updates to the custody rule as they get ready to propose the new rule. And we can tell already they're really focused on the right issues and want to understand how things are working and how auditors are dealing with some of the complex auditing accounting issues around custody of digital assets. So we do hope they are on the right track here and optimistic that the next version of the proposed rules will be more workable. But from a broader government lens outside of the SEC, I'd be remiss not to mention some of the activities from President Trump and Congress. In July, President Trump signed into the law the Guiding and Establishing National Innovation for U.S. Stablecoins, or the GENIUS Act, creating a federal regulatory framework for payment stablecoins. This is really a significant milestone and the first regulatory framework for crypto passed by the U.S. Congress. If you're not familiar, there's some benefits to stablecoins being faster and cheaper on international transactions. You don't need a bank to account or transact with them. And so this law really affirms that the stablecoins are chiefly a payments product rather than an investment product and places responsibility for their oversight with banking regulators. The law establishes clear eligibility requirements for payment stablecoins and is designed to ensure that only well-regulated and qualified institutions can participate in their issuance, management, and redemption. So we think this regulation can lead to more confidence in stablecoins and legitimize them as a product and provide protections to holders of stablecoins as well. There's also the Clarity Act out there. The House of Representatives has passed the Digital Assets Market Clarity Act, which would establish a federal regulatory framework for digital assets. There's strong bipartisan support for this one, and it's now with the Senate for consideration. So needless to say, it's been a busy year for crypto asset developments, and we expect more changes on the horizon that will drive increased access to the crypto ecosystem and provide some clarity in the space where it's been historically lacking. Second up on the themes has been retail access to private funds. Similar to crypto, we're seeing a much more favorable regulatory environment take shape for private funds and retail access to those funds. And so one example and some low-hanging fruit that SEC was just able to address was removing an old staff disclosure position. And so they officially issued ADI 2025-16, which was to tackle the previous limitation that closed-end funds could invest in private funds. So previously, closed-end funds were limited to investing no more than 15% of their assets in illiquid investments, including private funds, and that was lifted to ensure that closed-end funds could maintain sufficient liquidity to meet shareholder redemptions. That's why the redemption was there. So they lifted that, and we do think this is going to significantly increase the allocation of capital to private funds, boosting their growth and influence. More to come in this area for sure, as the DOL and SEC is also looking at opening up 401ks to allow for more investments in private funds due to the executive order entitled Democratizing Access to Alternative Assets for 401k Investors. And then lastly, on the themes, just to touch on the ETFs, as I mentioned before, there is a presumption that the SEC will approve the ETF share class for mutual funds that have applied. Caitlin Boddick, Assistant Director of IM, was recently speaking at the ICI ETF conference and mentioned that they're at the 1 yard line. So we believe approval is imminent there. My colleagues will certainly go into more detail here, but just from a regulatory lens, there's certainly still hurdles for fund groups to get over here. There's a brokerage account requirement that investors would need to have to access ETF shares. There's operational and compliance challenges, as well as potential conflicts of interest. And one of the major hurdles is ensuring that all investors, regardless of share class, are treated equitably. So fund groups are really going to need to demonstrate robust compliance mechanisms to gain SEC approval. And we are hearing that operationally, offering the share class is probably a little bit more difficult than many originally thought, especially if the complex doesn't already have ETFs. All right, let's move on to the next slide, though. I've been mentioning this regulatory rollback. So this slide really depicts that, what we've been discussing. There were 14 total rules that were rescinded as announced by the SEC earlier this summer. As you can see on the bottom of the slide, some of those rules proposed were formally withdrawn, such as cyber, ESG, outsourcing, and many final rules up top were delayed to allow more time for compliance. Some, as you can imagine, were dead on arrival, such as ESG, and we don't really see those coming back as the SEC shifts its priorities. However, some may be reproposed in a different form. It's also not totally out of the question that some of these rules on the top here could be indefinitely delayed and potentially rescinded, but it is more difficult to do that with a final rule that's been adopted and just not yet effective, as opposed to some of the proposals. It does appear, however, that the Form PF rule may be headed that way, given it was just delayed another year to October 2026, and that's hot off the press. Just saw that news come out today. As we think about reproposal, though, I would say that safeguarding rule, as I mentioned, is on the agenda. So we know that the SEC is working on that. And the predictive analytics rule is not on the agenda. So the future of that rule is much less certain. As we think about what was on the rest of the agenda, and you can go to the next slide if you need a refresher on some of those rules I mentioned. But as we think about, the future here, it's certainly crypto forward, as I mentioned, and deregulatory. And on the list of rules, other than I mentioned, I would say there's an import rule, potentially scaling back some recent amendments and addressing identified disclosure burdens. There's a new 17A7 rule, which expands the exemption for certain purchase sale transactions between funds, potentially updating what was done with 2A5 rule that prevented level 2 securities from being cross-traded. So I think that will be a big win for the industry if that goes through. That's been an item of contention. And as I think about other rules on the list, they're certainly trying to streamline things. So there's a shelf registration rule, which should modernize and help BDCs with that. And there's a disclosure rationalization rule to really facilitate material disclosure, all of which we can assume are, again, reducing administrative burdens on registrants. There's also been a lot of news articles recently as the president wants to get rid of quarterly reporting and pushing the SEC to look into that. So it's unclear at this time whether that would be captured in the disclosure rationalization rule or if it would be under another rule that's not on the agenda yet, but certainly something that would have to go through rulemaking. But in summary here, I think the new agenda focuses on capital formation, a balanced approach to regulation, continued scrutiny of crypto, and modifying previously passed rules. So this agenda, the SEC going forward, is going to be more pragmatic and less prescriptive than it was under Chairman Gensler, which should be a welcome news to fund groups. So with that, I'll pause. And Bruce, I haven't been keeping an eye on the chat if there's any questions, but happy to take any questions before we pass over to Bruce.
Hey, Ryan, on your scale back of reporting, I noticed Gary Gensler was actually on one of the business news shows talking about if they went to semi-annual reporting, that the end result of that could be enhanced and increased volatility in the marketplace. So he's back.
Yeah, it is interesting if it does go to semi-annual. I think it's happened in Europe, and some companies may voluntarily, decide to still provide quarterly information, but we'll see what happens with that. But Bruce, do we want to go to you on enforcement?
There are a few questions and answers that or questions that are out there that we could
Okay.
put out there, Ryan. You want me to read them or you want to hit them? The first one was, do you believe the SEC will invest in AI technology to increase and improve analysis of data they receive? Will that reduce field examinations?
Yeah, I mean, the SEC continues to do more with less. They have built internally a lot of tools already. They have a magic tool to look across disclosure very quickly. I wouldn't be surprised that they're playing around with AI as well and may implement it. I don't think they have the budget that the private companies and resources that Deloitte and others may have to implement AI, broadly. But eventually, I'm sure it will seep in and become part of their disclosure review process.
There's a few others. One on the liquidity rule. Do you see that?
No, if you don't mind reading them, that'd be great.
The question is, and anyone can jump in on this one, do you have perspectives on the liquidity rule in light of the SEC's decision to drop its case against fund directors for alleged failures, i.e. classification of investments? Could the rule potentially be overturned by the SEC or via a court case?
I haven't heard much recently on the liquidity rule, so something we'll keep an eye on and get back to this group if we do. Certainly anything would have to go through a rulemaking process if they were going to, update that rule, given it's already adopted. And then I see the last one here as part of the competition coming from CTFs with much less regulation. Certainly, I think we are seeing more competition come from other types of entities, CTFs, SMAs, different types of ETFs. So a lot of competition coming. Some of it, to Tom's point here, being maybe less regulated space, and we're seeing, this SEC really focus on more private funds and things in that space. So we'll see where it goes.
And obviously, you can see the ICI and others, and probably the SEC following at some point to follow the money, right, where the dollars are with investors, and the regulation may increase over time.
Ryan, another question just came in.
It's in the chat. I'm not seeing it. Oh. You can comment on the inconsistent reviewer comments, CODM disclosure. Is it regional office? That's a good question. I mean, most of the comments coming out of the SEC are from headquarters in IM if you're a mutual fund or BDC. So I'm surprised we're seeing too much inconsistency. Part of it could be due to the fact that I mentioned there's no SEC chief accountant in IM right now, which typically most of the comments would go through. But there are heads of disclosure, and we can kind of check in with what we're seeing with respect to that specific disclosure there, if we're seeing inconsistent comments across the industry.
Okay, good job. You've exhausted the questions at this point.
All right, Bruce.
Sure. Do we want to go to the next slide? Oh, got a polling question, Paul.
Yes, we do. What is the following is a key component of effective risk management for mutual funds? Regularly updating market strategies, ensuring accurate financial reporting, hosting annual investors appreciation events, implementing robust cyber security measures.
So certainly things that are important on there around accurate financial reporting, especially from the auditor view. When you think about effective risk management, it's probably leaning towards cyber, I'm guessing, on the end here.
Can show the results, so.
Yeah, looks like most agreed.
Okay, Bruce.
Yeah, sure. So if we go to the next slide. Yeah, so as Ryan alluded to, certainly not as much to talk about as in prior years when we've hosted events for fund directors and trustees. Clearly, the examination priorities that are identified here date back to the fall of 2024, so pre-Trump. At the time the staff issued its examination priorities, it indicated that they would continue to assess compliance programs, generally disclosures and governance practices, all basic tenets of, what we all think of as reasonably designed and implemented compliance programs. The staff also called out, the topics that are identified here in 1 through 4: fund fees, expenses, and associated waivers and reimbursements, oversight of service providers, portfolio management practices, as well as issues associated with market volatility. Although the pace of examinations has apparently slowed, these compliance topics I don't think are a surprise, and we'll continue to see, regardless of administration, to be focal areas for the staff during examinations. The other thing that I would just call out, I'm not sure of the composition, demographic of all the directors, trustees on this, is we are certainly, as a practice, seeing much more interest in some of these topics coming from fund sponsors that are part of banking institutions where the likes of the OCC and the Fed are trying to exert their influence over these organizations and how they approach, consider, think about their fiduciary duties as it relates to fund fees and expenses, as well as the other area, which seemingly is a hot button for the banking regulators right now. We've been involved in a number of enforcement actions, remediations involving firms' practices that are associated with oversight of service providers. And that's broadly defined, not only the fund's back office service providers, but also thinking about third-party sub-advisors who are managing assets on the bank or the subsidiary investment advisor's behalf. So clearly some focus areas here going across sectors of the financial services industry. Why don't we go pivot a little bit, because this is in many respects backwards looking. Let's also talk a little bit about enforcement actions that have come into play. Similar to the pace of examinations, the SEC's enforcement actions have slowed down significantly under the new administration. Under the prior administration, the SEC brought several enforcement actions right before President Trump took office that are relevant to the investment management industry. Have not seen a lot of activity since earlier this year. Thematically, these early 2025 cases focused on failures in internal controls, record-keeping issues, disclosures, governance, as well as general compliance policies and procedures, or lack thereof. In one instance, an investment management firm was found lacking in the implementation and enforcement of its record-keeping and communications policies. This case is very similar in nature to other cases that the SEC had brought against large banks and securities firms over the last few years. Well, the firm had adopted policies prohibiting business communication via personal devices and provided training regarding record retention requirements. The staff took the position, similar to the other enforcement cases, that it failed to reasonably ensure that these rules were being followed. The firm's compliance framework included self-attestations, which were very reasonable from personnel and oversight mechanisms. But the staff, once again, took the position that these mechanisms were somewhat insufficient. The SEC found that the firm's failure to implement effective monitoring led to the bookkeeping violations, which were core to many of these enforcement actions, as well as the firm failed to adequately supervise its employees and supervised persons. with a change in administration, and at the time, folks may or may not be aware, but early this year when these actions were brought, then Chair Ueda and Commissioner Peirce actually voted against these most recent enforcement actions related to off-channel communications. My sense is, given the Trump administration going forward, there's probably less of an appetite to bring these types of cases that are specific to record-keeping issues without more egregious conduct on behalf of the firm or their supervised folks. The next case I just wanted to call out from a thematic standpoint is a case involving an investment management firm that had weaknesses in their internal model governance practices, how they went about storing the models, as well as the approval processes that were associated with changes to the models. Model governance and data security continue to be an area of increased regulatory scrutiny, given the introduction and use of both investment and operational models to introduce efficiencies into an organization, as well as the use of artificial intelligence capabilities at financial services firms that not only are limited to our traditional investment management firms, but are being deployed across both bank-sponsored complexes as well as insurance-sponsored complexes. In this instance, the firm stored live trading models in a database that lacked access controls. Employees knew it, senior management knew it. They raised concerns internally at the organization, and the firm failed to address the vulnerabilities in a timely fashion. So some of these models remained available to certain employees, and a particular model made dozens of unauthorized changes, which ultimately impacted the investment performance at the firm. And this individual actually benefited economically for personal gain. The SEC, in this instance, found that the firm failed to satisfy its fiduciary duties by not timely addressing the vulnerabilities, which goes to when firms have issues that are escalated to their attention, they need to immediately think about how they're going to go about addressing or remediating. The other issue was, there were weaknesses in the design of policies and procedures. Once again, a pretty common theme when we talk about sort of investigations, examinations of firms. And the last case I just wanted to highlight was a large firm that experienced growth in its target retirement funds. The growth created a gap or more than anticipated delta in the expense ratios associated with their investor-specific fund and that fund that was made available to institutional investors. The firm went about, I think, with the best of intentions in developing and putting in place a working group to think about the issue and how they could mitigate it. They considered lowering minimum investments for the institutional target date funds, target retirement date funds, reducing expenses, as well as merging funds. The group, though, failed in the sense that they failed to contemplate the impact of what the lowering of the investment minimum would be in the institutional class to investors that were not investing through tax-managed accounts. And they also failed to consider that a significant portion of these investors that were not in tax-managed accounts, their assets were held away from the firm, so at other brokerages as well as wealth managers, and the firm didn't have visibility into the potential impact. It didn't contemplate the potential impact. The other interesting thing here is the SEC took the position that the firm failed to adequately disclose what it was doing with the potential impacts to both fund shareholders as well as the fund directors, trustees, when the board was considering moving forward with this plan of action. Ultimately, what happened was, significant redemptions occurred within the investor fund once the minimum was reduced on the institutional fund. That caused investors in these non-tax managed accounts to realize significant capital gains consequences, effectively 7x what they were the year before, and many investors suffered significant tax bills as a result. The SEC found that the disclosure to both directors and trustees, as I mentioned, and investors was inadequate. And they also failed to introduce compliance policies and procedures which governed or controlled how the firm thought about managing appropriate disclosures to end investors. So there were two elements here that I thought were significant for the trustees, directors here to think about. Once again, although SEC activity has slowed significantly in 25, the three highlighted cases that I wanted to just bring out here showed the continued need for robust written compliance policies and procedures, including consideration of emerging regulatory issues that Ryan has highlighted, as well as the emerging use of technologies, thinking about appropriately designed, implemented, and tested, as importantly, controls that support your environment, as well as transparent disclosures to beneficiaries or interested parties of that fund complex product. So all fundamental aspects of an appropriately designed and implemented compliance program. The one thing I would also note when I thought about this, preparing for this discussion, is the highlighted cases that I reference also illustrate how certain examination priorities tend to reflect themselves in upcoming cases. So as we think about, we're in the fourth quarter here shortly for 2025, the 2026 examination priority should be forthcoming. It will be telling to see what types of issues the examination staff calls out as focal areas for themselves going into next year, and see, shortly thereafter, if some of these issues start to resonate in emerging or recently issued enforcement cases as we move into next year, which seemingly was the trend, at least in the past. So I'll pause there, Paul.
Sounds great. There was one question, Bruce, that came in. If it had to do with, I can read it. Do you think the recent disclosures of disappearance of many of Gensler's emails will have an impact on SEC enforcement actions versus registrants based on defects in record retention policies?
Bruce, while you're thinking about that, I have heard that it may impact the SEC's ability to respond to FOIA, right, and their ability there. And it's certainly a bit hypocritical when the SEC is fining registrants about their record retention policies, but I haven't heard it necessarily impacting enforcement cases. I don't know. Have you, Bruce?
I have not. And I was going to say something similar. I would hope it would not impact, pending cases or contemplation of bringing them forth, but none of us has a crystal ball, so to speak. So, but I would hope not.
Great. The next slide, we have a question we want to, maybe the next slide. Next slide, please. So one last polling question here before we let Bruce off the hot seat. How ready is your organization for Gen AI from a risk and regulatory perspective? I guess you're going to throw in compliance, Bruce. I know Amanda said recently she heard 80% of the fund groups are in some sort of AI usage mode. So are organizations ready from a risk, regulatory, and compliance standpoint?
I'm interested in the polling question responses. I would say it's an emerging environment, Paul. I think, risk and compliance people, just like many of their colleagues at organizations, are trying to get their arms around and understand how these technologies can be used and how they're potentially being deployed or considered for deployment at their organization, which will ultimately then drive development of policies and procedures and testing. As I alluded to in the one case that I referenced, right, the SEC is certainly focused on data security and model governance. At the end of the day, these AI large language models are just models themselves. So there's certainly going to have to be a control that's established that will likely emerge over time as organizations become more sophisticated in terms of how they think about these models and how they allow them effectively to be used, both in the investment and operational processes to gain efficiencies.
Thank you. Yeah, the polling would say early stages and identifying and learning more about the new risks and regulations too that they need to comply with. It's interesting, at least the constant hallucinations conversation seems to have been supplemented by other types of risks and regulations that need to be focused on. So that's definitely progress is being made. Next, we're going to turn it over to Doug, Dana Miller. Doug, you want to take us into our FSI predictions?
Thanks, Paul, and thank you all for having me here today. I'm Doug Dannemiller. I'm the investment management research leader in Deloitte Center for Financial Services. So I have a team that we do research and write thought leadership papers for audiences like this. So I'm really looking forward to it. Every year we make a couple of predictions and we do some research around it on some really hot, what we think are important trends in investment management. For 2025, we had two predictions, one relating to retail access to private investments, and the other one was around active ETF growth. I think the year is proving that we picked those two really good topics for predictions, and let's get into talking about them a little bit. If I could go to the next slide. Next one, please. So exposure to private capital. I think, for a U.S. audience, I think the important thing here is looking at the European Union as a benchmark. And this is one of those areas where retail access and retail being not high net worth or already accredited investors, otherwise accredited investors, this is unaccredited investors, the penetration of those lower net worth retail investors into private capital is far exceeds the penetration in the US, in the EU. So what I would say is that's a really good benchmark for what's okay, right? There's certainly no structural issues have come up in the European Union around that retail access. It's been beneficial. And so this represents a meaningful opportunity for growth and distribution into the retail sector with private investments. Our prediction has significant growth over the course of the next 10 years, and it's really a very sort of small penetration. Still will not surpass the penetration in Europe, even as Europe also is expanding the same thing, the retail access into private investments. So currently there's about $1 trillion of retail assets found its way into private capital. It's really 90-10 Europe versus the US, even though there's significantly more retail net worth that's available to invest in these assets in the US. So it's 110 million of these retail non-accredited investors are poised to invest up there. Well, they won't get to 38 trillion, but they have 38 trillion available to invest, and we're thinking a small percentage of that can make its way into private capital, and that will actually mean significant growth. So if we could go to the next slide. So why is this happening, and how is it happening? And I think the big piece of this is there's some regulatory change, but the regulatory change is coming because there's demand for performance and demand for portfolio diversification, and that opportunity, as to why is it that retail investors are precluded from investing in an asset class that really has outperformed. Another interesting aspect of why this is happening is the limitation or the whittling away of public listings. In 1996, there were 7,300 listed companies in the U.S. In 2024, it's a little over 4,000. So the amount of companies that are growing and staying private, the unicorns, where all this growth and wealth accumulation is happening, has really been secluded away from the true retail investor. And so there's an equity stake in there. Is that, why is that? And one of the things from a regulatory perspective that's changing is that there's a potential for accreditation changes, and this is happening in the EU as well as in the US, and this qualifying your way in through education and demonstration of an understanding of the markets and the risk. So there's the demand for the asset class diversification and the performance. There's opening up from a regulatory perspective, both into new markets like the 401ks, which were mentioned, as well as changing individuals' accreditation access. And then I think there's a piece that goes along with this is sourcing of investment managers to find alpha, right? So the public public opportunities are diminishing, so perhaps open the door to find alpha and new investment opportunities in the private markets. This is going to happen across mutual funds, exchange traded funds, and interval funds. I think interval funds are getting the most attention right now. This is where I think in order to match distribution capabilities with investment sourcing expertise, that's where we're seeing a lot of partnerships between traditional investment management firms and firms that are have a lot of experience in the alternative markets. In the interval fund space, I think the regulatory environment is more understanding and welcoming of the private investments rather than in ETFs or in mutual funds, because of that semi-liquid nature of the interval funds. Although there are some ETFs out there that are getting crossing public and private investments into the ETF structure. So it's an important place for growth, and I think it's changing a little bit of the dynamic of the sort of what is the separation between private and public, and the firms, alternative investment firms, and traditional managers are sort of coming together to meet client needs and figuring out how they can both sort of benefit from that sort of structure. If we go to the next slide. In Europe, and I think this is probably best used as a benchmark here, but in the AIF structure, in the alternative investment funds, the assets have been a little bit flat, but it's in retail investing. But I think the total investments are still there, so the growth is a little bit flat. The point here is that there's a lot of room in Europe for investing in private capital. Some of the restrictions in Europe around how distribution restrictions around getting these funds in the hands of retail investors, like having brick and mortar in the location, are changing and easing. So there's going to be growth there as well. So I think that bodes well if you're thinking about the benchmark for U.S. investment and if Europe's leading the way in this penetration of retail investments into these marketplaces, we're probably safe as we're trailing behind Europe in that penetration. So if we could go to the next slide. And to wrap this up, we're likely in the U.S. to sort of narrow the gap between U.S. and Europe in the penetration into private investments by retail investors. So getting it beyond the ultra high net worth, and I'll say our prediction is probably different than most of what you might see out in the marketplace, where they mix high net worth or accredited investors with the retail marketplace. So we're focusing here on the sort of the unaccredited market that isn't included, isn't already have access to that marketplace. I think it's here to stay and will be gathering steam. And I think education and relaxing regulatory environment will really fuel the growth of retail investors, sort of safely and understandably into the private markets. So if we could go to the next one, we'll shift to our other prediction, and that's around active ETF growth. And I think if I had to pick, I think in the polling area, this came up as the number one thing that people were talking about was active ETFs and perhaps the active ETF share class. So if we take this forward into the next slide, it's a big opportunity. So first polling question is, what's your firm's position on developing active ETFs? And all of these that apply. Is it something you're currently not planning? You already have them? Are you using fund launches, share class launches, or somehow is this not applicable? Love to see the answers here. My guess is that there are many of you that are considering active fund launches either through a share class or just a new fund. And the results are, half either have or will launch, and are so it's kind of as expected with a nice distribution around doing it and the habit. And I think there's really lots of good reason for that. And there's where it's like Jesse James, why do you rob banks? Well, that's where the money is. I think active ETFs are going to be a significant growth opportunity for investment managers over the next 10 years. And I would say the major takeaway from this slide is that the AUM expectations for growth in active ETFs are significant and will go from a very low base to 27% of total AUM by 2035. So that's actually really huge, considering if you look now as to how slim the active ETF line looks in the mountain chart on the right. So comparatively, you'll see that growth in the top dark green significantly higher. Passive ETFs are going to continue to grow. On the mutual fund side, it's really fairly stagnant or actually declining in the active mutual funds. So that actually is supported by fund launches and closures. Recently, I think over the last 3 or 4, well, from 2021 to 2023, there were 460 new active ETF launches. And during that same period, there were 260 mutual fund closures. So the shelf space is changing dramatically. I think investors are really looking for that flexibility and lower tax implications and greater liquidity that are offered in ETF products. So as the industry has figured out issues like giving away the intellectual property inside the mutual fund and providing these liquidity through baskets and making it available on the marketplace, investors are really picking up on that, as well as the lower fees associated with the ETF structure. So we're looking like an $11 trillion opportunity at the end of 2035 for active ETFs. And if we go to the next slide, we'll see. We go to it's not switching for me. Okay, so here are some of the reasoning behind this. You see the number of fund launches. The net inflows are up from just 1% a decade ago to about 26% of total ETF net inflows. So that actually is a big part of our prediction, is that active is already at 26% of net inflows in the ETF space, and off a really small base. And the number of funds are continuing to grow, and I guess we have a lot of firms waiting at the gate to launch the active ETF share class. If you look at the middle, the fund expense differences are significant. Equity funds have a 22 basis point total expense advantage over their mutual fund counterpart, and bond funds have an 11% advantage. So the expense ratios differences are real, and the lower administrative trading costs and going through an exchange helps fuel that. The one, I guess, bastion between mutual funds and ETFs, the last defensive place is in the DC plans, where the advantages in ETFs really don't translate into the DC plan, and such as intraday trading. But I think mutual funds are under different pressures there, especially from the CIT structure. So we may see technology advancements that enable more liquidity for DC plan participants, but I'm not terribly confident in that. I mean, they've had windows in DC plans in the past, and I think they didn't turn out very well. So in this case, I think mutual funds in the defined contribution plans are have a stable environment, with the exception of getting competition from the collective investment trusts. If we go to the next slide, I think this is where the opportunities to launch new ETFs. You have fund launches. You can actually convert mutual funds, and then, as everybody knows, that there's a pending ETF share class out there. The considerations beyond that are how does it change operationally for ETF growth are actually fairly significant. Operationally, a authorized participant network is really important in an ETF. It doesn't exist in the mutual fund environment. Custodians are important. Developing talent that has the right experience in the ETF structure also critical. But for me, the issue that really strikes home and could potentially transform the industry is in this marketing and distribution. The traditional gatekeepers, if you will, on mutual funds and the ability to go through brokers is different in the ETF world than it is in the mutual fund world. Mutual funds are really good at paying for their distribution, and ETFs really are very thin in that regard. So I think there's an opportunity here for firms that have novel strategies and approaches that resonate with investors to gain share without sort of the advisor middleman in the way. And also through the fee-based advisor platform, if you can actually have that and capture it, you can certainly leverage it in the ETF marketplace. So this to me is the critical success point, the one that's probably least under control of investment management firms that are going here is how do you gain traction for marketing and distribution and get those products in the hands of investors, get them investing. And I think there's an opportunity for some new entrants to take advantage here and really sort of gain, move up the table, if you will, in ETF assets under management. So I think with that, we shift to the next slide and we have a polling question. So Paul, do you want to take this one?
Yeah, thanks, Doug, and great overview of the two predictions. So as Doug and the others have alluded to the fact, we're going to spend the next part of our conversation on ETF share class. So before I introduce the team that's going to do that, quick question on, so what's your prediction? I guess we get up to 80 applications in now for your fund group. What's the move on the ETF share class itself once it's approved? Plan to be a leader in this space and really launch ETF share classes off the majority of your mutual funds, fast follower, kind of wait and see what happens with the market and the investors' reactions. Dip your toe, maybe do one or two of your existing funds, or even though we have the application in with the SEC, we may or may not head down that road. And I'll turn it over to Jim, we've had numerous conversations, and even though we talk about the operational challenges, we still get into and tax and regulatory and governance. A lot of the conversations, Jim, go back to this point. So any predictions on your end?
I think, it's a great question, actually, Paul. So I think it seems like a balance between people who are trying to put their name out there and kind of figure out what they want to do versus those who want to actually actively open a share class. So I think there's kind of like a balance between both sides as to people are wanting to see what's happening versus what's going to happen going forward. But I do think, though, that we will see something move in the next couple of months, and we will see people starting to enter into the marketplace for sure.
Yeah. Well, great. We go to the next slide. We'll let Jim continue to introduce himself and the team that's going to talk about share class. Just two quick things. There were two questions. John, you asked a question around data. We currently don't have that data. We can look around and get back to you on that one. And then there's a good question by Jim on the success rate of active ETF launches and how many will survive a year or two out. So, Doug, I don't know if you want to lean into that one. It's a great question because there have been so many ones and twos ETFs, especially off of series trusts and different structures that are out there and may or may not be gaining traction and or AUM.
Yeah. So Paul, it's a great question because I think of the 1,600 or so active ETFs, 25% of the assets are held in 10 funds. So there are a lot of funds out there that are not getting a lot of traction. And that to me goes to that marketing and distribution issue of how do you get the story out there and in the hands of advisors and investors. So, it's a tough question. And I think it's a new, sort of new battleground for investment managers to get their brand, their story, their strategy out there through a new way with a new product. So I'd say it's an open question, and there will be winners and losers as there are right now. I think having the share class opportunity where you can carry performance forward and talk about that will also be an advantage for the incumbents, though. So it's going to be an interesting competitive play.
Right.
Great, Doug.
Jim, you want to continue your introduction and introduce the rest of the team?
Hi, I'm Jim Kearney. I'm a managing director in our investment management wealth practice here at Deloitte. And I focus mainly on operations, transformations, things of that nature. Matt?
Hi, Matt Romano, Managing Director in our tax department, and I focus on tax compliance and consulting with investment products and the managers.
And Maria.
And hi, I'm Maria Gattuso. I'm a principal here at Deloitte's consulting practice. I lead our investment management, regulatory, and remediation practice. I am an attorney by training, so before joining Deloitte over 10 years ago now, I was outside counsel for over 20 years. And as part of that practice, what we do is, we help clients implement regulatory requirements, whatever they may be. It could be as a result of a new regulation, or it could be as a result of enforcement actions out there where clients tend to look under the covers and make sure their organization is up to speed, or fixing things when things are broken, whether in connection with regulatory investigations, deficiency letters, etc., and the like. Jim, back to you.
Great, thank you. So maybe we go to the next slide. So like what we wanted to try and do here is have a conversation around the ETF share class as a opportunity for the industry. And so this slide we kind of put together as a view towards how the ETF share class would look across an organization, and thinking about it from front, middle, back, and governance, and thinking about kind of like what a firm may or may not have insights into. So one thing we get when we show this slide all the time is, I know that the high is green. We're not trying to say here that it's a risk rating. It's not like a risk orientation or what have you. The green here is really more about where do you have to focus as an organization. And so like every firm's a little bit different, and every firm's going to have a different view on what they do and don't do, and what they have internally or don't have internally, what they either have existing technology partners, things of that nature, but also like what they will and won't be able to do. So from this slide, we try and just say the green is really more where you need to focus. And so the green is the areas that, and you can see across the entire slide, there's a lot of areas to focus, right? It hits the middle, it hits the front, it hits portfolio management, it hits back office, accounting, excuse me. So the ETF share class issue is a big issue across the entire organization. And so what we're trying to think about here is really like, where do we see current organizations having questions, or where do we have in conversations, things of that nature? And a lot of that is really around, I won't drain the slide on the right-hand side, but the right-hand side of the slide is really like supposed to be the things that we're seeing the most conversations about. The biggest ones we hear a lot is around service providers, either people who have existing service providers who need to think about what they want to do from a multiple service provider perspective. My old firm where I used to work, we always had a rule that we would always have one service provider for all share classes. so we didn't have a multi-provider model. Some firms want to have a multi-provider model. It might be because of what they have from an infrastructure perspective. It might be from other reasons as well, but it's something that people really need to start thinking about and understanding why they would want to have multiple providers. A big thing that we're hearing a lot of conversations around is around the custom in-kind redemptions. And there's a lot of people who want to talk about the tax efficiency of the kicker and what that can do from an efficiency perspective, from an ETF share class perspective. But I think one thing that we need to think about when we're thinking about those custom in-kind redemptions is there is a market component, and people need to think about their partners and who are their partners from an AP perspective, who are their partners from a liquidity provider perspective, and what can they do to be able to use that custom in-kind redemption and be able to get access to a trade when they need it is an important piece of this whole thing. A big piece of what we're trying to figure out with clients is what they need to do around the conversion process. So it's a very hot topic right now with well, I guess you can call it conversion. You can call it a exchange. Everyone calls it something a little bit different, but the individual investor conversion process and going from the mutual fund share class to the ETF share class adds a lot of tax advantage for the individual. It also has advantage for the firm, of course, as well. But the process there is not fully designed. And so the thing that we're working on as an industry right now is figuring out how do we do something that's going to be more automated. Right? DTCC has been working on a process to be able to automate the function of going from the mutual fund share class to the ETF share class. But as of right now, they're thinking it's maybe June of next year. So it'll be interesting to see what happens if people start getting approved in the coming months. Will there be a manual process? How will that manual process work? There's a big conversations happening right now with the intermediary community on kind of like, as you can imagine, if there was 70 or so firms that are all doing a manual process in a different way, how that's going to impact the RIAs and the intermediaries. So it's a big thing for us to think through as an industry as to like, does it make sense to go forward with the share class and the conversion process as well? Or does it make sense as a manual process? Or does it make more sense to be able to have that be a automated process and wait for DTCC to get their work done, to be able to change their systems and have it be a consistent automated process? We'll see what happens there, but there's a lot of conversations happening as we speak right now. I'll stop for a second real fast. Is there any questions on the slide right now?
I think, Jim, just was an observation about the complexity and risks that might be created as you have share classes that have private equity, have digital assets, just more, harder to value type instruments.
Yeah, for sure. And I think that's one of the big questions that's out there. Like, so when we think about the active ETF space, like Doug said a couple minutes ago, like there's a lot of advantage for existing providers to be able to use their performance, to be able to generate the ETF and be able to use that performance as a kicker for the ETF. But we'll yet to see what's going to happen with like other asset classes when we think about like things like with alternatives and things of that nature, what will happen in this space as well. It's to be seen.
No other questions at this point.
Awesome. I think, Maria, this one is you.
Well,
Mute. Sorry,
Yep.
I was on mute. I always forget the
No
mute button.
problem.
Apologies.
No problem.
All right. So now I'd like to talk to you a little bit about the role of the board and how to implement good governance structure, a topic that I'm sure is very near and dear to your heart. So similar to other registered funds that you oversee, ETFs have the same general board responsibilities and governance structures as your regular registered funds. However, they are a different animal. So ETFs, there's some key differences that require additional considerations and board responsibilities. So before I go into sort of the different principles of governance, leading practices, and whatnot, I just want to take a step back and lay the context in terms of the different flavors of ETFs, because I think they do drive different responsibilities of the board depending on sort of which ETF you're overseeing, right? So we have what I refer to as the more plain vanilla, right? Those that are relying on the ETF rule, which was put out there in 2019, which means comply with the rule. You no longer have to deal with an exemptive order or any of the conditions under there. And those are the ones that have the daily disclosure obligations of, portfolio holdings on the website and whatnot. And that's how that arbitrage mechanism works. You also have those actively managed ETFs that don't publish their portfolios daily, right? So what we typically refer to as non-transparent or semi-transparent ETFs. Those do operate under an exemptive order granted by the SEC. So those conditions that are in there do implicate additional responsibilities of the board, right? So, for example, they may only be permitted to invest in certain specified assets or include certain risk disclosure, obviously, in the prospectus and the marketing materials that are really geared towards disclosing that there is that less transparency than you have with an ETF that is operating under the ETF rule, which could lead to an ETF share class trading at prices that differ from NAV at a wider bid and ask spread, right? So that obviously raises an additional consideration for the board to oversee and what the trends of that, that wider bid and ask spread might be. If at all. And then I would say like leverage ETFs and things like that also operate under there. So now we're down to the ETF share class, which is really the topic of this this discussion. And there's a significant number of applications that are out there, as I'm sure you're aware, has not been granted yet. We do expect it to move forward at some point in the relative near future. And there, if the exemptive applications are approved as are currently out there, so I'll qualify my comments with that, there's certainly particular considerations and processes for the board that are not present in a regular standalone ETF, right? So in particular, first and foremost, if an existing ETF is basically launching an ETF share class, the board is going to be asked to evaluate and determine that in addition, they'll be forced to evaluate that the addition of that ETF share class, which will be specified in the fund's multiple share class plan, is in the best interest of both the mutual funds share class, the ETF share class, but also the fund as a whole, right? There's a process that's built into the exemptive applications that basically have the advisor will prepare a written report that's going to include a multitude of information in order to aid the board in light of the specific circumstances of the particular fund in its consideration so that the board can make that determination, right? So key components of what is expected to be included in that initial advisor report is reasonably expected benefits and the costs to each of the share classes individually and to the fund as a whole. These can include things like, are there sources of potential cost savings and other benefits? Think about economies of scale. You have an existing fund and you have an ETF share class. It serves as a distribution channel to bring in additional AUM to be able to create economies of scale. in-kind creations and redemptions in the ETF share class, and those of any exchange privileges to allow the mutual fund share class investors to exchange into an ETF share class extension, ETF share class. The fund's investment strategy, is there going to be a potential for any, expected capacity or other constraints that may limit the fund's ability to invest in certain assets, the size of the fund, the shareholder composition, portfolio transaction costs, unrealized gains and losses, things like that. There's also going to be a description of an ongoing monitoring process that the advisor will provide ongoing reporting so that you can continue to sort of oversee this process. And that's a key component of the role of the board in this context. That really, the target of the view is a little bit different than what exists with current ETFs, standalone ETFs. So it's going to look at things like, you had this original presentation, original report from the advisor, you made your original determination. So have there been any changes from there? Anything that the board should consider from their original report in its consideration that this continues to be in the best interest of, again, both share classes and the board and the fund as a whole. Things that it should include are things like performance difference of the different share classes, right? Brokerage costs, capital gains distributions, and the like. And then in both reports, you should be seeing a description of any material conflicts of interest that may arise with operating in a multi-class ETF fund. So now with that background, let's turn to the actual topic of the page, the governance principles. I'm going to talk about the governance principle alongside leading practices out there so that you can kind of see what the leading practice, how the principle is being implemented in practice. Okay, so the first principle, accountability. What does that mean, right? Accountability is that roles and responsibilities are clear and decisions are traceable. So how is that? How do you see that sort of in terms of a leading practice? First is clear organizational structure, right? So that there's a clear org structure with ETF-specific reporting lines, both on the advisor side, but also on the board side. Charters, committee charters. Ensure that your committee charters explicitly cover ETF oversight, things like custom baskets, secondary market monitoring, and then well-documented escalation protocols that are actually ETF-specific triggers, right? So if you have a situation where you're seeing, as you're monitoring like authorized participant concentration or persistent premium discount, or there's index errors, right? Those things is a clear escalation protocol. The next one, I'm sure you're all very familiar with because it's really not different than just what exists in the 40 Act, right? It's independence, which is really that directors, an independent board to exercise objective judgment that's free from conflict. But what does that mean in the context of an ETF, particularly an ETF share class, which is a new kind of animal? So here it's to really, when you look at the board composition, it's a leading practice to have at least one director with ETF and capital markets and expertise, given how different these types of products trade from a regular mutual fund. Then you also look at, there's exchange requirements, right? They're listed on an exchange. So there could be a driver based on an exchange requirement. So for example, the New York Stock Exchange requires each audit committee member to be financially literate. Similar to what I'm sure you're all doing today, holding executive sessions without management, except that there should also be executive sessions regarding ETF-specific risks. And then outside counsel. It's a leading practice for the independent directors to have their own separate outside counsel. However, leading practice in the context of ETFs to have a counsel that is experienced in ETFs, the ETF rule, etc., and share class structures. Investor protection is obviously a principle, right? Safeguarding shareholder interests, and promoting fair treatment. So what does that mean in the context of ETFs, is particularly when you think about sort of capital markets and trading practices and the oversight of that aspect of the ETF. So if you're dealing with an index ETF, right, it's the oversight around that and scrutinizing the methodology and governance, especially if you have the advisor or an index provider that is affiliated. Valuation, paying particular attention to, basket security valuations, especially if there's any international assets. Distribution oversight. What I mean by that is ensuring that the ETF disclosure of the differences from the mutual fund classes. Jim mentioned tax treatment before. We've been talking about trading costs, liquidity, things like that. Make sure those are clearly disclosed. And then fees and expenses reviews, right? Confirming that ETF share class investors are treated equitably versus a mutual fund class. Effective risk management, right? So risk management oversight, what does that mean? Well, ETFs need to have liquidity risk management programs, just like, open-end mutual funds do, except that there's different ways to sort of oversee that in the context of an ETF, right? So there could be like, stress testing of the ETF baskets, right? And monitoring sort of any kind of mismatches vis-a-vis underlying markets. Let's see, there could be the relationship between the ETF's portfolio liquidity and the way the ETF shares are trading, and particularly in terms of like the prices and the spreads, the efficiency of the arbitrage mechanism, the level of active participation by market participants, so really geared towards the operational components of the ETF. If they use derivatives, if the ETF uses derivatives, evaluating the derivatives usage across the share classes and the effect on the ETF basket construction. Cybersecurity, that came up earlier in the webinar. Obviously, it's a focus area, but what does it mean? So focus on authorized participant trading systems, for example, or order routing or index data feeds if you're an index ETF. Risk dashboards have become a leading practice, right? So when you think about being able to sort of visualize and require the ETF-specific metrics in a dashboard, particularly ones where you can navigate them, where you can see things like tracking error, spreads, AP concentration, etc. Transparency is where directors and shareholders receiving clear, timely decision, like useful decision information, right? Again, in terms of leading practice, it's transparent reporting, dashboards, perfect example, right? Where you can provide concise ETF dashboards. It's a lot easier to sort of be able to look at trends, identify trends, and be able to get metrics that are specific to the risks of overseeing an ETF. Seeing in those dashboards exceptions, right? Highlighting abnormal trading days, for example, or wide spreads or failed creates and redeems. Anything relating to sort of the clarity around distinguishing the ETF share class experience from the mutual fund share class experience in the report. Don't forget, one of the main concerns in these exemptive orders is that you don't have a subsidization, by one share class over the other, right? In particular, the ETF share class over the mutual fund share class, or frankly, vice versa. So anything relating to that to make sure that one class is not subsidizing the other. Regulatory compliance. Like other funds, you have your 38A1 compliance program, you have a CCO with oversight over that program, and that does, periodic and at minimum an annual review and formally reports on the results of their annual review to make a determination that the policies and procedures are reasonably designed. For ETFs, it's requiring that compliance reporting is specific to the ETF operations, right? Whether it be basket constructions, particularly in the case of custom baskets, authorized participant agreements and complying with those and the like. Making sure that the testing and the exceptions are for ETF specific risks, as I mentioned before. And then just, regular updates and briefings on any sort of, regulatory changes or any sort of expectations or monitoring the, or the required conditions under the ETF exemptive order. And that's actually the last point I would say is that share class compliance in the case of share class ETFs, you're going to want to make sure that there's a monitoring and sort of testing that those SEC conditions are actually being complied with. Conflict of interest management, right? So that's always key. And it's always a regulatory focus area. And it is an area where, you'll see deficiencies and you'll continue to see enforcement actions, regardless of who's at the helm at the SEC, because it's just so integral and a part of sort of the fiduciary obligations that an advisor, an advisor owes its clients. But what does that mean in the context of an ETF and leading practices, right? It's, again, that disclosure, reporting any sort of ETF share class conflicts, right? Whether it's in relation to, the allocation of the cost or any liquidity advantage or whatnot relative to the other share class. If there's custom baskets and there's an affiliated transaction that you have an affiliated policies and procedures that you have to worry about, particularly in connection with non-pro rata baskets. If you have an authorized participant that is an affiliate, right, or a distributor or whatnot, monitoring the use of those affiliates. And then, just the board process in terms of whether there's any, need for sort of escalation for the conflicts or recusal, frankly. And last but not least, continuous oversight and education. And that's very important. I'm sure it's something that you're all getting today. But here in the context of ETFs, it's really getting regular ETF specific training, right? Particularly in terms of, capital markets, creation, redemption, trading dynamics. If you're bringing in a new director, making sure that onboarding, there's a part of that orientation that's really tailored for ETF and multi-class structures. You may want to have external input, right? So maybe let authorized participants come in and talk to you, or if you're overseeing index funds, have some of the index providers come into some of the board sessions. And then part of any good sort of board governance process is a self-assessment at least once a year, but including sort of ETF oversight effectiveness in that annual board or committee evaluation. All right, so now I'll talk briefly about the role of the board there on the left-hand side. This really is not different than what I'm sure you have heard throughout your entire tenure as a board member. You have a fiduciary obligation, given your board position to the fund and its shareholders. Under the 40 Act, these ETFs operate under the 40 Act. You're basically the independent watchdog. I'm sure you've heard that term before, and it's because it's a very paternalistic statute. These exemptive orders are paternalistic, and there's that sort of enhanced requirement of board involvement around certain things that really give it that, independent watchdog sort of lens to it. The oversight of fund management. There's a big difference between in terms of the board's role. You're not there to kind of do, you're there to sort of oversee. But when you're dealing with the operations of an ETF that Jim was talking about, particularly when you're adding an ETF share class and the complexities that brings to the organization and the different areas that it hits, right? It's sort of laying out a path forward where you can feel that you're properly executing your role as a director by overseeing how fund management is going through the operations of the ETF. The contractual approvals, you're very familiar with those. Thing is, like with an ETF, you have different kind of contracts or additional contracts, like with authorized participants, for example, or an index provider or whatnot. Performance and risk monitoring is obviously key to the role of a board, and in particular when you're dealing with the addition of a share class, understanding the performance between the two and getting good reporting and transparent reporting on that. Compliance oversight. Again, as I mentioned before, making sure that the CCO has that compliance program that's been uplifted to cover the ETF specific risks, the ETF specific policies and procedures, and you're getting that in your periodic reports from the CCO. And then obviously as part of that, it's the adoption of those ETF specific policies and procedures. Any questions before I go to the next page? Okay. Next page, please. Next page, please. Okay, great. No, the prior page you were just on. Yes, right there. So this one, I'm not going to go into a lot of detail on this one, particularly given in the interest of time, but what this slide basically lays out, if you kind of think about the different ETFs, right, and sort of some of the focus areas from a governance perspective, or some of the board structures and committees that you typically see out there or would see out there in the case of a share class ETF. I thought it was helpful. But the main takeaways are, I would say, you know, and that's why I sort of started with the different flavors of the ETFs. Depending on the type of ETF, that's really going to impact how you execute your role as a board member, because it's really going to impact what types of things, what kind of data, what type of information and reporting you need to see to effectively execute that role. So that's really important. In terms of board expertise, I put that all in terms of, you know, board education. If you think about, you know, products are always changing. We have novel products. Share class is an example of a novel product, right? So making sure that board education includes sort of staying on top of and novel products and novel practices out there in the market, as well as, you know, thinking about if you're looking to launch an ETF, you already do not have ETFs, and it is basically a new skill set. If you don't have anybody on the board that is, you know, familiar and has expertise or knowledge about ETFs, maybe think about, you know, bringing that level of expertise in. And then adapting your committee structure to ETF type. It does not mean you need to add a bunch of committees, right? You could look at your existing committee structure and just look at, you know, what the purpose of the committee is, and you can bring it into your existing committee structure, or establish a new committee. The main thing is that the items are covered, right? Regardless of how you accomplish that. I don't know, unless there's any questions, I was going to pass it off to Jim.
So real fast, I mean, I know we're getting short on time, but like, give us your opinion on the tax side of this whole thing. Like,
yeah, absolutely. So, you know, and some of this is going to be reiterating some items that you guys talked about, but I just want to make sure we stress like the tax impact of some of the nuances with ETF share class. You know, what the first thing, and Jim, you alluded to this, is, you know, the process of moving mutual fund shareholders to ETF shareholders, ensuring that the process is such that it doesn't trigger a taxable event for the shareholder. So, you know, and I think that's something that'll be worked out that you alluded to, but, you know, you wouldn't want a foot fault that would result in a taxable event and kind of defeat the purpose of that shareholders moving to an ETF share class. So, you know, obviously we've said that the tax efficiency is a big driver, but it's important to note that, you know, for you to have this undertaking, that it would benefit, you know, be to the benefit of the fund shareholders. So again, considering the base of shareholder in that fund, you know, is there sufficient non-qualified accounts to make it worth their while? And then the fund strategy, again, that it would allow for the fund to benefit from the in-kind provisions. So, you know, funds with heavy derivative activity or an international presence that in areas that wouldn't allow for the in-kind mechanism, you know, these would be things that would impact the ability of the in-kind provision. You know, considering the historical subscriptions and redemptions of the fund, you know, if there's higher volatility in subs and reds, This could result in some leakage that could have a negative impact on the ETF share class. So, some capital gain distributions could move into that class. What percent of the fund is in, dividend reinvestment, and, does the fund need to have economic sales in order to generate cash to meet distributions? That's something to consider. And Maria alluded to this, but the tax attributes of the fund prior to the conversion. So, does the fund have capital loss carryovers that it could act as a backstop? The ability to harvest. Does the fund have the ability to harvest tax losses? And what percent of the fund's net assets are from unrealized gains? And then one thing that could also be an additional benefit is, by setting up this ETF share class, are you creating the infrastructure and relationships that would allow the mutual fund share class to benefit from the in-kind provisions? Whereas a large redemption out of the mutual fund share class, you could utilize an in-kind. And the last thing I'll mention is, the 852b6, which is the provision of the tax code that allows for the benefit from the in-kind provision. That's can be a controversial area, and there's always discussion regarding, its viability in the future. So that's just one thing to kind of monitor over the next months and years as Congress is considering various tax updates. That's really it. Jim, any additional issues to discuss? You're muted.
Muted,
You're
Jim.
muted, Jim.
Sorry, guys. Yeah, so no, that's great, Matt. I appreciate it. So, there's one question that came in through the chat around expense ratios. I mean, typically, expense ratios for the ETF share classes are going to be lower than the mutual fund share class. It's just what we've seen in the past, and what seems to occur. That's part of the value of the ETF share class, but to be seen as to how big that delta will be as we get into this multi-share class view and get into active ETFs. It may not be as wide as what you see right now, but it's to be seen.
Great. Any parting shots? I know we could have spent the 2 hours on this topic. Otherwise, we'll move to valuation quickly. Okay. Great. Well, thank you. Matt, Michelle?
I can pick up from here. Thank you, Paul. My name is Matt Morlock, Audit Senior Manager, one of the authors in our Fair Value Survey, and I'm here with Michelle Coombs, who's another Senior Manager in our Kansas City practice, who also helps put together the survey, one of the authors as well. For the sake of time, we'll move pretty quick. Go to the next slide. I think we have the required polling questions, but we can go through this one very quickly. Which area would you like to most like to see the investment advisor make further enhancements within your fund group's valuation operating model? Enhanced clarity on when matters will be communicated under prompt notification, price challenge process, identification, mitigation, and conflicts of interest, private equity, other less liquid valuations, and other board reporting. And I'll note these are all topics we focus on within our fair value survey that comes out every single year, which we'll highlight as well. So maybe another few seconds, then we can show the quick results and get into the topics here. All right. 59% of people said they're focused on private equity and other less liquid valuations, which does align with what we see in the fair value survey. A lot of people have been focusing on illiquid investments here. For the sake of time, we can probably skip past this slide as it talks about previous survey trends, which will segue into some of next year's, just coming year's surveys as well. But just a quick background on what our survey is. Each year, we try and get 100+ participants, and we've now hit that, I believe, 4 years in a row to fill out the annual fair valuation survey. This provides data, insights, lots of topics that we use to identify emerging and industry trends and see them grow over time and see how industry tackles certain challenges such as implementing Rule 2A5. There's a variety of topics on the screen here that we cover every single year, but we're always refining our question list, looking through additional ideas that people want to cover. So everything from valuation, use of generative AI, to how 2A5 adoption's gone, SEC examination results, all part of the survey here. And with that, I will pass on to Michelle for the 2023 initial sneak preview.
Yes, I realize we're at the top of the hour, so I'll keep it brief to wrap us up. But our intention here is to give everybody a little bit of a preview. We conducted the 2025 survey over the summer, and we're currently working toward publication of the results at the beginning of October. Our plan here is to release those early October and essentially launch the survey at the ICI Tax and Accounting Conference the first week in October. So this slide just hits on a couple, some highlights that you can expect to see in this 23rd edition of the survey. This is our third consecutive year with over 100 participants, so we're glad to see that there's continued interest in the questions and continued use of the survey as a benchmarking tool across the industry when it comes to valuation practices. Most of the highlights that we included on the slide here are some of the areas where we continued to update the question set, to Matt's point, to include new questions and touch on some topics that we know are top of mind across the industry. A big one in there is the use of Gen AI and trying to get a better sense of how fund shops might be using that. Last year was really the first year that we saw any kind of interest in that question set and respondents indicating some use of it. And this year, as expected, we see growth in that response, and we see more and more saying, yes, we're using it. And this is some of the use cases that have been helpful for our group. So I'll kind of cut it off there and just say on the next slide, we have a little bit of a promotion for our breakfast at the upcoming ICI Tax and Accounting Conference in October, with the intent being this is where we're going to launch this year's edition of the survey. We'll have a panel from Deloitte and some joining us from industry to talk about the key themes and industry trends of this 23rd edition of the survey. So those who will be in attendance at ICI, we hope you'll join for that.
Great. Thanks, Michelle and Matt, for giving that quick overview. So thank you, everyone, for joining us. We really do appreciate it. And thanks for all the presenters that did a phenomenal job communicating and getting their points across. So we hope you join us for our spring edition in 2026, believe it or not. And if you have any feedback for us, please let us know. And obviously, if you have any further questions, feel free to reach out to anyone on the team here. And we look forward to meeting you in the future. Thank you for your time.